The American stock market and the economy are slowing down in 2025. There appears to be something bubbling up under the surface, ready to slow us down, maybe towards recession, but certainly towards stagflation. One of the reasons why America has done so well since 2020 economically has been due to the robust gains in jobs. However, we are starting to see a crack, and the amount of jobs gained in 2025 is significantly weaker than they were in the previous few years. We are talking about a clear downward trend that's going to take more than a few words from the president or from central bankers in order to fix it. But what's really concerning is that we're stuck between a rock and a hard place. We have a slowing down economy, but also inflation that doesn't appear to be going anywhere. Price growth is refusing to go down below the Fed's target levels, and therefore we are creating this perfect storm of weaker economic growth, fewer jobs gained, as well as high inflation. We are going towards something called stagflation, which is one of the worst economies in general, but especially when it comes to investing in the stock market. The government and the Federal Reserve effectively have their hands tied. Either way, they can either stimulate the economy, which is going to reignite inflation. Just remember what happened a few years ago. And if they don't stimulate, then we're slowly heading towards recession. The only way we can avoid that bad scenario is if in the true economy, maybe it's artificial intelligence, whatever it is, we need to see a huge increase in productivity of workers. If we don't see that, then usually the end result is recession. Economic concerns alone might scare away some investors, but if you also pair up high valuations and slower profit growth with the weak economy, all of a sudden people start to question, why are they fully invested in the stock market? We are currently experiencing a change in the stock market. We are seeing a difference compared to back at those 2022 lows. We were seeing companies with very strong growth coming up at very low valuations. That's the best time to invest. For example, in the past few years, some companies returned investors ×2 to ×5 of their initial investment. This is showing us the overwhelming proportion of companies out there, at least in the S&P 500, that have profited investors over the last 3 years. We could have brought in a blind monkey at those 2022 lows and thrown darts at this heat map, and you probably would have bought those random companies and made a decent return. If we now swap that heat map to a 1 month performance, you're going to see a very different picture. That same dart throwing monkey would have a very hard time picking companies or guessing in today's market compared to 3 years ago. In order to see just how the fundamentals have flipped in the market going against us now, whereas we had really strong tailwinds before, we only need to look at one darling of the stock market, and that would be Meta stock, the owner of Facebook, WhatsApp, and Instagram. During 2022, Meta's forward P ratio was only around a 10, which if it moved up in valuation to where it is today at a 26, that's a 160% return just from an increase in valuation, not even considering the overwhelming growth in profits. If we also show the profit growth at that time, we usually look 12 months forward. So in 2023, Meta experienced a 200% profit growth. In 2026, we only expect a 7% growth. Meta is one of the best stocks currently in the stock market, and yet even for that company, valuations appear to be towards their maximum. Growth is stalling out to around 10% per year moving forward, maybe 15%. So if we're lucky, we're going to see 15% returns per year, and they're probably one of the best companies out of the entire S&P 500. Most companies are doing worse than that. Keeping the focus on big tech companies right now, if we only look at the Magnificent Seven, which includes Nvidia, Microsoft, Apple, Amazon, Meta, Google, and Tesla, those companies alone now make up 32% of the entire S&P 500. In good economic times, such as the past 3 years, you really want to be invested in those high growth tech names. They reward you more than the average S&P 500 company. However, if we start to experience any economic hiccups, then having such a large proportion in tech companies that are sensitive to the economy, well then all of a sudden that equation flips on its head. It's actually a bad thing that big tech makes up up such a significant chunk of the market. For example, we only need to look at Amazon. They're such a great company and one of my favorites. I invest in them right now. However, if we do go into a slowdown in the economy, or if we go into recession, just like what happened in 2022 with the inflation wave and the affordability crisis, Amazon went from being a profit printing company to all of a sudden losing money, not just shrinking profits, going into the negatives. If we just had an economic slowdown, not even recession, you could see the S&P 500 earnings drop around 20%. That would also result in a valuation collapse of around 30%. Now, putting that together, you would see a 44% drop in the S&P 500. The poetic Greek tragedy of this is that big tech has become such a big part of the market because of their success, and the S&P 500 has benefited. However, if that all of a sudden turns into a selling pressure, then that sort of feedback cycle is going to flip negative. All of that theory makes sense, but I just want to see some practical data and also supported by some trustier names. So we're going to jump into JP Morgan and how they've come out with a report looking at the past 27 years. They looked at the correlation between the forward 12-month P ratio and the subsequent 10-year returns on the S&P 500, and if we trust this model, then we are expecting 0% returns for the next decade. We could see this play out in really two different ways. We could have violent moves upward, but then have a collapse in the stock market straight after, averaging zero, or we could actually just stay stable where we are today with our current knowledge of people's psychology and also greediness in this modern age. Then my money's on the first case, seeing some violent volatility over the next decade. With all of that preamble and just the thought that institutional investors probably know what they're doing, then everyone is suspecting the next decade's going to be pretty hard. It's going to be the stock picker's decade, and that just means we have to be really scrutinizing in terms of our investments, picking companies that have good profits moving forward, but also are at decent to low valuations. And with that in mind, we can now address three different routes we could take in terms of managing money. So the first one was just sitting in cash, kind of just leaving the casino and letting the whole situation play out, hoping for a crash soon so we can reinvest at lower valuations. Now, the problem with that is we just don't know what the next 4 or 5 years is going to look like. We could be setting up for that 1996 to 2000 time period, all of this excitement about technology and also growth in productivity. We could see the entire average of the market go up 60%, some names going up 300-400%. And if you're sitting on the sidelines watching that happen, I bet you're going to start making some bad decisions. You're going to start trying to invest money at the peak, and you're going to lose even more money than if you just stayed in the market the whole time. In my opinion, I think that leaves us with two real options here. The first being, do we play it safe and pick low valuation, lower growth names such as Adobe Stock, or do we pick something like Duolingo, a high growth company, and just hope for the best, hoping we don't go into recession? For those unfamiliar, Duolingo is a language learning app, and they've gamified the process, and they have about 3 or 4 different ways now in order for you to practice your skills, which, coming from an education-based background, teaching people, that's just a really smart strategy in terms of picking up the basics. The app now has over 500 million downloads, and we are continuing to see roughly 40% growth in users, but also people willing to pay for premium features. This company has a very short history in the stock market, and they've only become profitable in the last couple years. They went public in late July 2021, going through an IPO at a valuation of $5 billion. This chart is showing us the yearly value of IPOs going back the last 30 years. And we've seen a huge drop in terms of the dollar value of those companies. But if we keep in mind that each IPO now has higher value than it did in the past, the absolute number of these companies has dwindled off a cliff. This means the investing community, who are hungry for high growth, are having to funnel their cash into just a few names. Think of companies like Robinhood, SoFi, and Palantir. If you know those those names, you know that they are vacuuming up all that investing cash. They have reached extreme valuations and are firmly placed in bubble territory. We're going to need to talk about a price to sales ratio, how many dollars you're willing to spend for every dollar that Duolingo has made in revenue. They started at a 10 at IPO, but recently, a few months ago, they peaked at a 26. You're paying $26 for every dollar of revenue. There are some companies in China right now, decent names like JD.com, where they're priced at 26 cents per dollar of revenue, not $26, 100-fold less expensive than Duolingo. If we directly compare that to a tech company in America that's just got lower growth but much safer, then we have Adobe here to compare against. Their price to sales ratio is only sitting at a 7. At this point, I'm going to move on to Adobe Stock. I did a huge video on them not that long ago. You can find the link to that video in the pinned comment. Summarizing Adobe though, their growth rate in profit moving forward is around 12% per year, so about the same as the S&P 500, but with a 30% less valuation. So that's a decent buy, at least compared to the average of the market. Less risk because the valuation is already at rock bottom. If we went down 40% in Adobe stock, that'd just be extremely unlikely. Comparing that to Duolingo before, with their lofty valuations sitting at a forward P ratio around a 65, you could easily see another 40% drop in the stock, and that would not be a surprise at all. All it would take is a couple bad news pieces, one bad quarter of performance, and the stock could drop, like I said, 30 to 40%. You might think my answer in terms of which investment is better right now would be Adobe because of the safety, but I don't think that answer is overly clear. It just depends on what investment you are after, what suits your portfolio. For example, if I go to my model portfolio, I have started a small position here buying just one share of Duolingo. Every time Duolingo goes down 10%, I'm just going to buy another share and sort of average down the price. If you want more of a consistent returner, maybe hold it for a 3 to 5 year period, then maybe Adobe is more what you're after. If you like this one, I've got 2 more videos for you to watch. I hope to see you there next. Bye.